Well then, I'm glad we know that now. All right. Boom. All right. So how to trade a bear market. So hopefully we can go the next 20 years and never use this logic. However, it's not likely. So first thing, what is a bear market? So a bear market can be cyclical or it could be long term. It could just be a cyclical rotation, which is possibly what we're seeing right now. You see steel prices and inflation going up and growth stocks and tech stocks going down. That can just be a cyclical rotation that lasts a month or 3 months. It's been going on for about 3 or 4 months now. Um, or it could be long term. It could be 3 years of constant downtrend. If you go back in time a little bit further, you could see, 3 years is a bit much, but 1 to 2 years is definitely possible. Um, so a bear market happens when market sentiment and trends start downward. So the market sentiment starts getting more cautious, less risk taking, um, and obviously the trend of stocks starts trending downward. Typically, for it to be a technical bear market, most people will tell you a 20% decline is necessary. That's like what constitutes a bear market in a lot of people's mind. It's actually not technically true. There is no set amount. I would say like if stocks were dropping by 0.001% every day for a year, they might only lose 10, 15% total over time, but it would still be a bear market because it was consistently a downtrend. All right, so the ways that you could trade a bear market are you can short sell. You can short sell with shares. It's like she sells seashells by the seashore. Um, you could short sell using shares, so just borrowing shares from your broker and selling them short, meaning you have to pay back the shares at a later date when they are not as pricey. So take Peloton for example. Right now, Peloton is $98. So what I could do is I could short Peloton, sell, 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 sell when it's $98. And once it gets down to $80, then I can buy back however many shares I owe the broker that I borrowed to short sell them at 98. This is actually, it can be a safer way to do it. It depends on the stock, it depends on the broker, it depends on the fees, it depends on a lot of variables. But it can be pretty safe to actually short sell shares because you can have a lot of time to cover and it doesn't necessarily put a date on it as a option contract would. It might. You can always get a margin called and you could have to pay at any time really. But typically it can be safer than options. I don't prefer. I prefer to do everything with options. I prefer to leverage everything I got. Um, so the way I prefer to trade a bear market or even a bearish stock or anything I'm bearish on is by short selling with options, which would be selling calls and selling call credit spreads the same way that we've sold put credit spreads in the past, or selling puts for a bullish market. Just take everything bullish and just flip it on its ass. So that said, leveraging and hedging using puts, and I was probably going to say put debit spreads. That's what I meant to put there. So, but basically, let's say you have a heavy stock position and a bearish market has come. We think it's hard to confirm bear markets. Is another hard part of it, but we think it's a bear market. It's in a downtrend, but there's no reason for it. Maybe like it's not justified as a bear market. So you don't want to sell all your stocks because then could just be like a short attack. It could just be a bad week, a bad jobs report, whatever the issue is. You don't want to sell your position, so you hold the position. You average down a little bit. But one way you could do this without losing your ass is you could hedge using a put. So let's say you own a few hundred shares of. Since Tiffany's not on the call, I'll use her favorite stock as an example. Let's say you own a few hundred shares of Pinterest. And you see a bear market forming, you see some more bearish trends forming, you're hearing some negative sentiment on the news. It's looking like it might be a rough couple of months. But it's also very volatile. It's been going back and forth, up and down, and you don't know what to do with it. So instead of selling your whole position and just holding cash on the sidelines and praying for a bounce or praying for it to keep going lower, and then you'll be able to buy more, you can hold your current position of hundreds of shares or whatever you have and just buy a put. You could buy a put farther out that's more out of the money. So for Pinterest, for example, you could buy a $40 put a month or two out. And that way, if it continues in downtrend for a month or two, you're going to see that put's value increase, which will offset the loss that you have in your stocks. And maybe when you see it start to reverse, you take profits on the put, buy some more stocks on the dip, average down your average price, and now you hold those shares at a lower cost as it comes back up and reverses. So also like a put debit spread, if you want to do that and have it cost a little less money, because with the bearish market typically comes higher premiums and more volatility. So the higher premiums because of the more volatility. But with that, you sell puts on top of the puts that you buy. So just like a call debit spread, put debit spread. Let's use Peloton, buy a $90 put and sell an $80 put. So because we know it's going to go down, but we probably don't think it's going to go down past 80. And that way you're making your money, but you're limiting the premium cost by selling options off of the options that you buy. All right, so when to enter a bearish market. This is the trickiest part of a bearish market, and one reason I'm probably not as profitable during a bearish market. I'm best, and I don't even know if I've ever traded a technical bear market because we've had a bullish 4 or 5 years. My most intense trading years have been very bullish. And then when COVID hit, it knocked us back. It was like the correction of a century or the crash, like a flash crash type thing where like we had 3 awful weeks and then it was uptrend after that for the next 30 weeks. So I'm hesitant to trade in a bearish fashion because I've never even seen a real bearish market. I wasn't trading in 2008. I wasn't trading in 2000, and even those crashes, a lot of companies went out of business, but it didn't result in a long-term bearish market, 10 years of downtrend or anything like that. So that being said, when you see a bearish market starting to form, the first thing that you do is you wait. If you're in my alerts or anything, you notice that I kind of started dabbling in puts last week as the downtrend started to confirm itself. I started dabbling in puts, but I was still buying some calls in some names and some puts in some names because it was still kind of more like a cyclical rotation than a true bear market. Also, I was buying puts last week to hedge some of my call positions that I was deeper in, maybe with some leaps for next year. So I Tesla leaps. So I bought some Tesla puts. Those Tesla puts did very good. My leaps barely lost any money because they're so far out. Most of what I'm paying for there is the premium. So it's important to wait. If you see a bear market forming, just wait, let it confirm itself. Don't go all in short selling. You will regret that. Corrections and pullbacks can often serve as like a bear trap. So it could look like it's a crash or a bear market. In reality, it was just a correction from a stock that ran up too fast. Some traders, so like a lot of hedge funds and crazy people, might trade bearishly on the way up in anticipation of a top. So I actually know somebody who was bearish on FCX, on copper, Moran, whatever the fuck that thing is. FCX is the ticker though. They started shorting it at 25, 30 bucks. So this thing has ran way too fast, way too hard. Yeah, it's still in an uptrend, but it can't last much longer. So let's short it. Last I checked, FCX was about $45, $50 now. So it looks like it's going to reverse. Now I'm getting bearish on it. Now I think it might reverse soon. However, that doesn't, I wouldn't short it right here. I might buy some puts. That's about it. I might sell some call credit spreads, but I would not short that stock because you can get screwed real quick there. So for me personally, I prefer, of course, I'm the options man. So option trading in a bear market is what I'm going to prefer. My personal preferred method is call credit spreads. So I went into put credit spreads with you guys in the past, and I know you guys have been trying those. Some of them we're still waiting to expire. Some of them we got a little bit screwed on. Some of them we made some good money on. So it's been kind of all over the place. And the reason for that is we've been using them in a I don't want to call it a bullish market or a bearish market right now. It's kind of like a neutral market. It's a very sideways trading market. So the put debit spreads worked good on some of the less touchy stocks, but then some stocks just got crushed the past couple of weeks. I mean, some are down. We're way past the bear market. We're down 50, 60, 70% from highs on some stocks. So it's definitely not looking great for the bull market here. But I prefer to sell call credit spreads, so it's similar to put credit spread, except the opposite way. And that's a neutral trade technically, a slightly bearish / neutral trade. You could also buy put debit spreads, which I like because I don't like paying high premiums. Puts have really high premiums typically in a bearish market, especially because volatility is up. And then that's why the less ideal option would be the puts, just naked, not really naked, but just to buying puts and trading puts in a downtrend would be the least ideal option if you're going to hold for any period of time. If you're using it as a quick day trade or a quick swing trade for some leverage, that's fine. All right, so call credit spreads. So you'll see me, I might also refer to these in like the alerts or somewhere else as CCS. You ever see that? You know, I'm talking about call credit spreads. So the way that you would form one of these is you would sell the lower strike call. So I can give you an example after this a little bit. And buy the higher strike call. The higher strike call is essentially serving as your stop loss in the same way the lower strike put would serve as a stop loss in a put credit spread. So it's similar to a put credit spread, it's just the opposite direction. You do receive the payment immediately, so you'll be credited immediately with the amount that you make. But it does likely tie up some collateral. It's rare you'll have a broker who will just let you sell puts without having any cash with them. So it does work great though, because if you know anything about me and my strategy, well, it used to be 50% cash, now we're 50% crypto. But when I was 50% cash, it was fine. It's not hard to have collateral of 50%, or it's not hard to have cash collateral when half of your account is in cash. So it's really easy to sell these put credit spreads. Also, you need less collateral when you sell a put credits or a call credit spread, rather. Sorry, you need less collateral selling a call credit spread than you do just selling a call without buying one on top of it. The same way with a put credit spread, you need less collateral if you do it as a credit spread, not just selling a put. All right, so an example of a call credit spread would be if you sold the Peloton June 11th 100 strike call. Those are going for about $5 a share right now. So you're going to be credited about $500 for selling that call. But then you're also going to want to buy a call just in case Peloton goes to $150 for some crazy freaking reason. I hate that stock. It should be like a penny to me. So you're going to want to buy, or I would buy the June 11th 110 strikes for $2 a share, $200, which would give me a net credit of $300. Now my max loss is $700 because the difference in the strikes would be $10 times 100 would be $1,000 minus the credit of 300 makes the most I could lose 700. For me to lose that, Peloton would have to go above 110 by or around June 11th. So it's really about the expiration date. No one ever exercises. I don't want to say no one, but I've never had it happen to me of anyone exercising anything before expiration date. So what's the risk? So the risk is if Peloton goes above 100, you're responsible for producing those shares at the price of 100, no matter what the current price is. So if Peloton goes to 105, you are still responsible for producing 100 shares of Peloton for $100. You would just lose 500 there. But if you were credited already with 300, your technical loss would be 200. So to limit the risk, that's why you buy the second call off of the call that you sold. And if you really wanted to limit risk, you can lower the strike of that call, but that's also going to lower your return. And that's pretty much the case whenever you're trading anything ever, is if you have a lower risk, you're going to have a lower return. That's why I like the risky biskies. All right. So in summary, best part about trading options, of course, is we can leverage our cash to trade any market in any direction, but please, please, please be careful. Bear markets are tricky and they're often accompanied by high volatility, which means high premiums and higher risk. Trade smart and never chase. That includes the way up or the way down. I prefer to wait for them to be confirmed, and to trade with spreads is usually the best way to limit our risk. So Jared, I know you're on this call. I know you had some noise in the background. You're probably doing something else at the same time and recording this and watching later and da da da. But if you have any questions, I'm happy to answer them now, Jared.
So my only thing on that is you had for Peloton, you had June 11th. Do you want to go that far out? Do you like going that far out, or do you like doing weeklies? Or
weeklies are cool. I like doing weeklies. I like doing weekly everything, and I have some really weird logic behind that would go against a lot of like fundamental knowledge of trading. Like the way it's supposed to be done is not how I do it. So when you go a little bit farther out, it gives you a little bit more time for the play to work, because you can always end this play. Like you can always buy it back, right? So if you go a little bit farther out with the strikes and Peloton goes to $50 tomorrow, you can just buy it back for super cheap. You know what I'm saying? So that's the only logic in going a little bit further out. You do get the most decay in the last week or two. So if you wanted to go 1 to 2 weeks out instead, that would be fine too.
and when you pick the strikes on the strike price on that, are you looking at like the deltas or just where?
So
it's
I'm
been?
gonna get into one going over that. Nah, you should. A lot of people do. I do all the Greeks in my head. I don't have to look at them. It just I just calculate it pretty naturally, and that works for me. But I understand that most people can't necessarily do that. So you should pay attention to it, but it's not the first thing on my mind. The first thing on my mind would be the market trend. So Peloton's a growth stock. Peloton just had kids dying with treadmills and crap like that. And inflation is rising. Pelotons are back ordered. It's going to hurt their business. It's going to hurt their earnings. I would probably trade Peloton around like earnings, which the premiums are going to be cranked no matter what. And it's risky. I might close it before, or I just go a little bit farther out with the expirations for Peloton in particular. I'd probably just buy a put on Peloton because it could fall so fast that it'd be better to catch it that way than with a credit spread. But it just came to my mind because I really don't like Peloton. So whenever I'm thinking of a bullish or a bearish market, that's what I'm thinking of. I'm thinking of Peloton. And if nothing else, the other thing I wanted to go over real quick, actually, let me do this. I'll just let it keep recording. Maybe I'll make this a double. Is to go over a quick, you know what? I'm gonna end this one and I'm gonna start a new one so that I can put these. I'm making a new portal or a new course. It's gonna be like an advanced trading course. I hope somebody wasn't trying to get in this one. And I'm gonna put this video in there, so I want it to be. So I'm gonna end this call, and then I'm gonna start another one to discuss IPOE and what that market manipulation is all about. All right.